Thank you and welcome. ABC Proprietary Limited wants to purchase a new machine to increase its production of children's toys. ABC has engaged Victoria United Finance to consider the weighted average cost of capital, available funding sources, including costs and projected cash flows. VUF will undertake 3 different capital budgeting methods, being payback method, NPV, and ROI based on the formula provided. VUF has assumed that ABC will consider both the financial risks based on VUF's advice and non-financial risks of the project. Large companies such as Lufthansa take this approach. We'll also assume that the before-tax cost of the corporate bonds is 5.15%, which is 165 bips above the government securities rate of 3.5%. The WACC is the average after-tax cost of ABC's various capital sources, which include equity, debt, and preference shares. The WACC is the first component of capital budgeting and tells ABC how much it needs to gain off its investments to maintain overall value. It also provides ABC with an understanding of the cut-off points for investments. By way of example, ABC has a WACC of 6% and wants to embark on a project with a return of 5%. The WACC mandates the minimum return to make the project viable. In this case, this project would not be viable for ABC as its return of 5% would not cover off its capital costs of 6%. The WACC is commonly used as a discount rate when calculating the NPV of a project. ABC has various sources of debt, including a bank loan, a mortgage loan, and corporate bonds. The details of each are on the slide. ABC's pre-tax cost of debt for the bank loan and the mortgage loan is respectively 8 and 11%. ABC has instructed VUF that the pre-tax cost of the corporate bonds is 165 bips over the government securities rate of 3.5%, being 5.15% in total. VUF has calculated the market rate of the corporate bonds at $713,660. The market rate of the corporate bonds is higher than the overall face value, as the coupon rate of 6% is more than the market rate of 5.15%. The bank loan, mortgage loan, and corporate bonds respectively represent 28.5%, 11.26%, and 30.91% of ABC's capital structure, with a total aggregate amount of 70.67%. ABC has ordinary shares issued, the details of which are on the slide. The capital asset pricing model is commonly used to determine the cost of equity. The CAPM formula and its components are outlined on the slide. ABC has instructed VUF that the risk-free rate is 5.4%, the beta is 1.4%, and the market rate is 4%. The expected rate of return for ABC's ordinary shares, and hence their cost, is 11%. ABC has issued preference shares, the details of which are on the slide. The cost of the preference shares is determined by dividing the preference dividend per share by the preference share price. The preference dividend per share is 10 cents. The preference share price was $1.36 at the end of 2018. The cost of ABC's preference shares is 7.35%. The ordinary and preference shares respectively account for 21.74% and 7.58% of ABC's overall capital structure, which is 29.32% in the aggregate. The cost of debt and equity has been determined. We can now determine the WACC. The next step is to determine the individual weight of each source of debt and equity. To do this, the total value of all sources of debt and equity need to be computed, and this equals $2,308,660. To calculate the individual weight of each source of debt and equity, VUF has taken the outstanding amount of each source of capital, divided it by the total capital amount, and multiplied this amount by 100. To determine the weight required to calculate the WACC, the cost is multiplied by the individual weight. In the case of the bank loan, this means that 8% is multiplied by 28.5%, which equals 2.28%. The impact of tax needs to be taken into account for all sources of debt. Therefore, 30% is taken off the further weight of all sources of debt. ABC's ultimate WACC is determined by adding the final weightings of each source of capital. On this basis, ABC's WACC is 6.53%. Project cash flows can be segregated into 2 categories, being inflows and outflows, and 3 groups being the initial investment and operational and terminal cash flows. ABC conducted a feasibility study to determine the costs associated with the project. VUF has taken a look at the feasibility study and has determined the project's inflows and outflows, whether such cash flows are initial, operational or terminal, and the impacts of depreciation and tax on project cash flows, using a diminishing value for depreciation. The table on the slide outlines this analysis. The initial cash flows for the project are $410,000, reflecting ABC's investment in machinery, purchase and installation and working capital. The operating cash flow for each year of the project is identified in the table, being $466,500 in the aggregate. The operating cash flow takes into account revenues and expenses, opportunity costs, and impacts of taxes and depreciation. The terminal cash flow for the project includes the salvage value of the machinery, which is $50,000, tax paid on the salvage value, which is $15,000, and the return of working capital originally invested, which is $10,000. The project's terminal cash flows are $45,000. As noted, ABC conducted a feasibility study. A feasibility study is a sunk cost, meaning that it cannot be recovered. Accordingly, VUF has not included the feasibility study cost in the capital budget. VUF has considered and applied 3 different capital budgeting methods to the project, with the first being the payback method. There are 2 ways to calculate the payback method. First being the simple payback method, by subtracting the initial investment by the annual cash flow. Second being the discount payback method, by discounting the cash flows against a discount rate. VUF has used ABC's WACC as a discount rate. The discount payback method takes into account the time value of money, addressing a key deficiency of the simple payback method. To calculate the simple payback method, VUF analysed the operating cash flows from each year and determined how long these cash flows would take to pay off ABC's initial investment. ABC will take 4.16 years to pay off the initial investment. This time is lessened if terminal cash flows are taken into account. To calculate the discounted payback method, VUF discounted ABC's operating cash flows against the discount rate. It will take ABC 5.31 years to pay back its initial investment in the project. Accordingly, it will take ABC longer than the machinery's operating life to pay back its initial investment. This time is lessened if terminal cash flows are taken into account. NPV is the present value of cash flows at the project's required rate of return compared to the project's initial investment. To calculate the project's NPV, VUF determined the project's initial, operating and terminal cash flows, including the impacts of depreciation and tax, discounted the incremental free cash flows against the discount rate, and added the present value of all of ABC's present cash flows over the life of the project. The project's NPV is $17,400. There's a reduction to this if terminal cash flows are not considered. The pros and cons of NPV will be explored further. ABC's CFO requested VUF to calculate ROI by assessing the total outlay and averaging the total operating cash flows over 5 years and dividing the average operating cash flows, being $11,400, over the initial investment by $410,000 and multiplying this number by 100% to form an ROI percentage. The ROI percentage is 2.76%. VUF considers this a less reliable method of calculation and as it does not take into account the time value of money, like NPV. NPV is considered a superior means to make capital budgeting decision as opposed to payback and IRR methods. The key reason for this is that NPV considers the time value of money, that is, translating future cash flows into today's dollars. NPV is also a complete measure of profitability. There are some limitations to NPV. NPV's biggest limitation is that it requires an element of guesswork about capital contributions and expected rates of return. If a company's assumptions in these areas are incorrect, then the NPV calculation will also be incorrect. Based on the project's NPV and other calculations, VUF recommends that ABC proceed with the project. However, ABC needs to tightly manage its terminal cash flows. Reason being, the positive NPV is wholly dependent upon ABC realising its terminal cash flows. The capital budget itself does not give insight into the ultimate value that the project could deliver to shareholders in the future. The project satisfies the long-term needs of ABC's customers, therefore creating long-term value for ABC shareholders. This factor, compounded with the positive NPV, makes the project an attractive proposition for ABC. A more detailed discussion paper has been circulated, providing an overview of this presentation. Thank you for your time.